And I highly doubt I would be here right now if it wasn't for those guys. But it was a small, profitable business. We were the best in Leeds at what we did. The first is you have to have an opportunistic mindset. The refurb's going to cost us about £12,500 maximum. That includes a contingency. And it will add, roughly speaking, about £25,000 worth of value to the property.
Great entrepreneurs see opportunity where other people don't necessarily.
Hello and welcome to the very next episode in our podcast series. And this one's a little bit embarrassing because I am actually the guest of this particular episode. I had the pleasure of being interviewed by Richard Coulthard. Richard is a director and also head of corporate and commercial at Ice & Harrison Solicitors. Ice & Harrison are a firm in Leeds and West Yorkshire. They have 20 branches actually across Yorkshire itself, 280 employees, turnover in excess of £20 million. I use for my conveyancing and I can recommend them with confidence. Now, in this particular episode, Richard interviews me and we talk about property, we talk about business and other areas of life. I'm going to break this down into two parts as well because this was an hour-long recording. It was a long one. So this video is more or less 25, 30 minutes and there'll be a subsequent episode which again is 25 to 30 minutes. So I really hope you enjoy this one.
So Marco, you're an entrepreneur. I think that's fair to say. You've had businesses, you've had property, but give us the brief history. Where have you come from and where are you now? Sure.
Well, firstly, thank you very much for having me on your podcast, Richard. And before I answer your question, I need to give a shout out to two very special people at Ice & Harrison. And no, that's not my lovely sister Shannon that works with you. It's partner Chris Waddingham and also Adam Henderson who works with Chris. These guys are second to none. They've helped me in my property portfolio and I highly doubt I would be here right now if it wasn't for those guys. So thank you very much to Chris and Adam if you're watching.
Yeah, thanks for that. So you started... I read a news article about you starting business at sort of 14 years old. So take me through the journey, the brief history, and where have you got to where you are now?
I think it was slightly earlier, Richard. So one of my first ventures was washing cars. So when I was 12 years old, I used to just go around the local neighbourhood, £3 for the outside or £4 for the inside. We just do a few of those. Don't get me wrong, in the winter that was not a nice thing to do, working when it's 0 degrees, your hands, you can't even feel them anymore. But they were the most profitable times because all the other kids didn't want to join me during the winter, so I used to pocket all that £3 myself.
As someone who also ran his own car washing business in his teens going around my village, I can very much relate. It was a great way of earning some cash. You didn't really want your mates helping you because you got more, just took you longer. That was the downside, wasn't it?
It takes a bit longer, you can't do as many. But from there, I did several things as a teenager. I used to do some market stalls here and again, which were good fun, selling all the kind of boisterous things that guys that age want. Then from there, I had a wrestling business. I used to love WWF wrestling, so I used to import.
Who was your favourite wrestler?
I used to like the Big Show.
Okay.
Yeah. What about you?
I was very much a rock person.
Oh, People's Elbow. Okay.
Yeah, something like that.
Yeah, great guy. So I had a passion for wrestling. I don't really anymore once I found out it wasn't real, but I have a passion for wrestling. So I created this website where I retailed WWF merchandise in Europe. And at that particular time, Richard, if you were based in Europe and you wanted to buy any WWF merchandise, you had to go directly to their Eurozone shop and they charged you an arm and a leg. It was 3 times the price of the American shop. So I used to get it shipped to my uncle who was in America. He would forward it on to me in Leeds and I'd sell it at half the price as the Eurozone shop. And I had a very good year doing that.
And then you went from running that and that website, you had a digital marketing agency, didn't you? So tell us a bit about that.
So we're fast forwarding quite a bit there, almost 10 years effectively. However, from my skills of building this wrestling website and increasing sales on the website, I learned through mistake and trial and error and experience how to do SEO, which for anyone who doesn't know what SEO is, it stands for search engine optimization. It's the process where you rank a website at the top of Google. So if someone's looking to buy, the Rock t-shirt and they type that into Google, hopefully your result's going to come up first and they click on your website and buy the t-shirt. So I taught myself this skill on how to build a website and how to make money from the website. And then I thought, well, why don't I sell this as a service to other businesses that are looking to either improve their website or generate more sales? And, I just really started there. It was just me in my bedroom in my dressing gown, no one else, and slowly grew the business up. I mean, don't get me wrong, it never got to a large size. We had 5 employees at the absolute maximum, but it was a small, profitable business. We were the best in Leeds at what we did, and ultimately I sold that to a much larger agency in Leeds.
So you've gone from there and obviously selling that business, and you're now involved in property. Well, I think you were involved in property at the same time, actually. But tell me about the property journey. What was that always been an interest for you, or is it something that's come later on?
Yeah, it's a very good question, and there's so many areas of my life where property kind of became known to me. But from an early age, no, I had no ambitions. I didn't know anything about property at all. However, I remember my first year at university. And I was forced to, I wouldn't say choose, but there was only one accommodation left. So I was forced to stay at this particular place of residence, and it was really expensive. It was £100 per week, all bills inclusive, which at that time, when I went to university, is a very extortionate rent. So I remember moving in and thinking, wow, there's 5 levels, there's 12 rooms on each level, so there's 60 units at £100 per week. That's £6,000 per week in total to whoever owns that building. That's a lot of money. And I remember thinking, well, maybe one day I'd like to do something similar to that and have a rent roll of a similar nature. And it's actually quite funny, as I was preparing the notes for this interview, our rent roll now is not too far off that figure in such a relatively short period, which I think is quite incredible. However, then in my final year at university, I went to Lancaster University, and your first year you are on campus. It's campus university, you have your campus life, but then you're encouraged to move off campus for your second and for your third year. So for my third year, we were in a 5-bed HMO in the town. And, this was a more realistic, I suppose, goal or ambition, a 5-bed HMO. We were paying £75 per person per week. So, the landlord's making a modest sum. I didn't know anything about mortgages then. I didn't know anything about refurb or developments, nothing of that nature. But again, I remember totting up thinking, if you had a few of these, it's not a bad income, right? Then it all started after that. So I got my graduate job in London, FTSE 100 company. I took a place in Elephant and Castle to rent, which at the time I didn't know London, and I still don't really know London that well now. It was a terrible place. I think now it's come on a bit, but back then it wasn't a place you wanted to be. And the agent somewhat, I'd say, missold me the flat share.
The dream, shall we say?
The dream. It just wasn't how he described it, and certainly the people who I was sharing with weren't as what he described. So I basically said to the company, I feel like I've been missold this flat share. What can I do I just want to move and find somewhere else. What can I do to get out of this contract? And they said, well, if you replace yourself, if you find someone else who's willing to replace you, we'll let you leave. So I thought, okay, well, that's fair. Let me try and do that. So I did it the exact same way how I came to know this flat share. There was a website called Spare Room. It's still going to this day. You just advertise the room for rent. You take a nice picture, you write a compelling description, and you deal with the inquiries. And within a couple of days, they'd let it. And I was like, oh, wow, that was actually quite easy. And it didn't cost me a lot. It was less than £10 to advertise the listing for a room that went for over £700 per month. This is a long time ago. Now that would be 4 figures. And I just remember thinking this was just too easy, and I'd like to do more of this. So then I started contacting landlords who were advertising their property, but I believe the advert wasn't very compelling. So either it would have no pictures, no description, or just very unfriendly in the way they marketed the property. So I just reached out and basically said, I'm local to the area. I can come round, take a nice photo, write a bit of a description. I can even do the viewings if you want me to. I tried to get out of that, but sometimes they wanted a full package. And it's no let, no fee, so you've got nothing to lose. And it kind of slowly took off from there. I was doing very small numbers, I'll be honest, I was doing 1 or 2 a month, but it was a good income for me, it was a good side hustle, and that was my way how I got into property, through being hands-on and actually learning the ropes before actually owning any property whatsoever.
That's quite entrepreneurial. I suppose it's seeing an opportunity, and it's converting that into an income. Property and business there's different skill sets, but there's an overlap there. Would you say is that fair to say?
Yes, there is an overlap, and I know where you're going with this because you asked me the question in the brief that you sent before, and I've made a few notes here, and I was trying to think what would make a what are the qualities of a good entrepreneur? Is this the question you're trying to ask?
We're heading in a direction, so...
Lovely. And I honestly have been thinking really hard about this, Richard. And the first is you have to have an opportunistic mindset. And I don't think, or I find this can be somewhat hard to develop. I think you've either got it or you don't. And you need to see opportunities where other people don't. And if we just use property as an example, I'll give you a perfect example which happened recently. A one-bed house on the market. It's on the market for a fairly high price in the sense that, you know, the numbers are somewhat tight. For most investors, it's not going to work, only for a handful. So therefore, most investors would go that either put in an offer that they feel works for them, which may not work for the seller, or in fact they'll probably get put off because they think, wow, we're going to have to get this at such a discount to make it work. I just don't want to insult the seller. So I kind of went in. I thought, well, how can we add value? What can we do differently here? Where's our edge? Where's our margin? And it was simply it was a one-bedroom property, and the bedroom was very large, very, very large bedroom, and it also had a bathroom, and the bathroom had a window in it. So I thought, well, what if we can convert this one-bed house into a two-bed house? Because the main bedroom, the only bedroom, is huge. What if we were to partition just a bit of that off, move the bathroom into the bedroom, have an extractor to take out all the moisture, and then convert the existing bathroom to a bedroom? It's a simple job. And that's what we've done. We've made this deal happen by doing that. The refurb's going to cost us about £12,500 maximum. That includes a contingency. And it will add, roughly speaking, about £25,000 worth of value to the property. So the net on that is 12.5. It's well worth doing. But the other reason why this is worth doing is we'll get an extra £125 per month in rent. So there's just so many ways that we can make this deal happen. And if you didn't have that opportunistic mindset where you can see things that maybe other people can't see, it's very difficult to make these deals happen that seem somewhat dead from the onset. So I think having that opportunistic mindset is really important. And the second, I'm only going to give you two because I made 5 or 6, but let's just make it 2. I think you need to be persistent. I've forgotten what the equation is. I think it's something like persistence plus adaptability equals success. So you've got to be really persistent in doing whatever you're doing day in, day out, but also not be afraid to adapt things or to just only tweak things slightly if that process isn't working for you. And I believe that, well, first of all, I'm very good at persisting. I'm less good at adapting, but I'm very good at being persistent. However, I do eventually get the adapting part, and it will come to me, but probably will come to me a bit later than it comes to most people. And therefore, in general, I am successful from a business or financial point of view.
Yeah, I think great entrepreneurs see opportunity where other people don't necessarily. And as you said, it's about making the figures stack up, or maybe thinking of things to a different mindset perhaps. I think I've certainly seen, and we advise lots of property investors at various stages of their journey, certainly probably in and around Leeds or sort of immediate surrounding areas. Maybe the conventional, I'm going back a few years, maybe the conventional flip, buy to auction, sell it on, or that it's become harder to make money out of that. Is that fair to say? Would you agree? 110%,
especially in today's environment, Richard. Flipping is the last thing I'd want to do. In fact, there was a post in my property group this morning about a potential flip, and my response was, now's the time you don't want to be flipping. Prices are stagnant; they're not really going anywhere. In a rising market, great. You've got a nice margin of safety to flip in a rising market, but in today's society, I would be very reluctant to flip.
So when you're looking at a property deal, and you must see loads come across your desk, or you go hunting for them, what are you looking for? What's your key components, I suppose?
Yeah, it's an incredible question because a lot of people will search and start their property search without that in mind. So let me answer it. There's 4 parts to it. You'll see that 3 of these 4 parts are attributed to the capital side, and only 1 of the 4 parts is attributed to the rental or yield side. And that's, again, to illustrate how important the capital and equity side is compared to the rental and the yield. So first of all is, what discount can we get? And this is a really important thing that it's somewhat difficult to explain, so I'll try to explain it. So you have what's called a market value, which is what someone's prepared to pay for the property, right? The lovely thing about property, this is why I'm so pro-property, is that the market value can fluctuate wildly in such a short time. Whereas in the equities market, if you're looking at the price of a stock, that's somewhat unlikely. That value, the difference between the share price and the intrinsic value is going to be quite small, because there are a lot of very smart players in the equities market, hundreds of thousands of players, and therefore, us as a retail investor, it's harder to get that edge. But coming back to property, we can get that edge because, let's say there's a property for sale now as we're recording this in 2024, the second quarter of 2024. The property market is slightly improved, but it's nowhere near what it was in, say, 2021, where it was very difficult to even book a viewing. It was just so hard. You'd call to book a viewing, and 20 slots were filled, and that was it. Now it's different. You can get a viewing because now competition is slightly less. Let's say you've got 3 or 4 people viewing a property. Well, out of those 3 or 4 people, they pretty much dictate the market value if it's on Rightmove or Zoopla. If it's off the market, that's a different story. Nowadays, you can get quite lucky. Let's say 3 or 4 people view a property. One of them, I don't know, his daughter ends up going to hospital that day, his mind's elsewhere, he's not thinking about money or property or business. The other, maybe they just can't get the math to work and they just maybe don't want to come across too insulting with a lower offer. And maybe someone else offers. So someone else offers and you offer. You've got a 50-50 chance effectively of getting that property, providing the seller is willing to sell. Not all sellers are willing to sell. So you can profit from this. And let's fast forward, say, I don't know, 2 years from now, maybe we could be in a market similar to 2021 where competition is fierce. That market value can go from 120 to 150 or 180,000 pounds in a couple of years. So you have to profit from that difference, and that's our job as investors. So that's number one, is the discount. Number two is what value can we add to the property? And I've just given an example previously about converting the 1 to the 2 bed. There we're adding £12,500 worth of value. Is there any value to be added? Maybe the answer is no, but it's obviously worth exploring. Number three, again to do with the capital side, is what do we think capital growth is going to look like in that area in the coming decades, in the 20, 30 years? What's it going to look like? Very, very difficult to forecast, it's very difficult to plan, but we have to put something on it. And if we're investing...
On that, I know that there was a mindset at one point around Leeds about building around where HS2 was going to be, getting obviously HS2 then gets canned, and those people presumably then lose out, or at least don't make the gain they thought they were going to get. Is that fair?
Yeah, but potentially it's very hard. I mean, it's very hard to analyse the effect of that because there could be so much going on in that particular area, Richard. There could be, yes, HS2 may have not expanded to that area, which is bad for property prices, but generally speaking, there could be good employees in that area. There could be a high percentage of owner-occupiers, could be low crime, good transport links, good schools. All these fundamentals could make the capital appreciation actually better than average, even if HS2 is no longer coming to that area. So I think you're 100% right. However, it's so hard to work out why an area performs and why an area doesn't perform. And I'd love to meet the person who can give me that answer. It's certainly not me. But to come back to your original question, capital appreciation, we have to forecast for it. We have to be buying in areas with strong fundamentals. Lastly, the last part of this question, now only then do we come on to the yields and the rents, Richard. And this is really important because the vast majority of money you make in property is always through the capital side. It's always through house price increases, value add, buying at discount and equity rather than your rental income. A lot of people confuse property investing and think the majority of wealth is created for rental income. It's not for most strategies. So the last thing I think about is rental income. What's the yield on the property? An obvious, very quick method of comparing properties, but also what is our return on capital employed? So we measure the amount of cash we've got in the deal compared to the net rents over that year, for example. So that's what I'm looking at, a particular deal.
You're looking at a deal and you talked about capital versus yield. Do you have deals that you approach, looking at almost like a pure capital gain, or is it some of them purely about yield? HMOs typically are a better yield, or do you look at it from a combination, or is it a case you've got some, like, these are purely about capital growth, I'm holding them for long-term investment purposes, and these are the ones I might not get much capital growth, and you might be thinking about commercial units and things like that, but actually the cash is quite good in the short term. How do you balance that?
It's a very good question to ask. And the answer depends where you are in your property journey and what's important to you. So, for example, let's say you start out, you're working a 9 to 5 job, you've got a bit of cash to invest. Well, most people's goal is to generate their 9 to 5 income, but through a more passive manner, through property. So they, as you rightly said, Richard, could be going to HMOs that generally pay more in the short term, but less in the long term. So those strategies worked really well for me when I first started because I wanted to maximise my income from the get-go. But then there comes a point in your portfolio where you think, oh gosh, this is just a headache. Yes, I'm making more cash in the short term, but I'm losing so much in the long term. So you start to pivot your portfolio more towards capital and income becomes less important. So that's for me, I'm always looking at capital now. Yes, income's nice, but we've hit that level. We can live comfortably as a family. We've hit the income level, so now it's capital. And how do we take the portfolio to the next level and really get into that next bracket, is what I'm trying to say.
So let's take that example. So you've got what we see quite a lot is you've got an individual who's got a well-paid job, in a career of some description, or as a couple they might have, I don't know, and they've got a desire to get into property, but they don't necessarily know how, or they've got this idea in their head that all rich people have property and it's really easy, passive income. I'm going to come back to passive income as a point, but in that situation, where would you say they should start?
It's a very good question. First of all, they need to have an idea of what strategies are available. And there's a famous phrase, you don't know what you don't know. Many people don't know of lucrative property strategies. Don't get me wrong, they're not for everyone. It depends how much time you've got, how much knowledge you have, and how much time you're willing to invest in learning knowledge, also on capital. But to give that, for that particular example, working couple, they've got a bit of savings, they're looking to invest. You're never going to go wrong with buy-to-let. Don't get me wrong, it's not the sexiest strategy. It's not going to make you a millionaire in weeks or months. But long term, I'm a big believer of buy-to-let. It's the most passive of all property strategies, excluding commercial. And that's why I really like it, because if you break down the income on buy-to-lets, your hourly rate is significant. Even though you make more money in HMOs, if you break down your hourly rate in the HMO, it's far, far less than any buy-to-let investment.
So, I'm an individual, I've got, 40,000, 50,000 tucked away, I go, I want to buy a property. Are you saying, be safe to begin with, go with a straightforward buy-to-let and see where, is that what your advice would be?
Exactly that, it could be, if you're lucky, it could be a 3-bed semi if you get it at a really good price point. But if not, you've got 2-bed terraces you can buy all day with that kind of cash and put down a deposit. You'll probably be making a few £100s a month at current rates. If they come down, maybe a bit more. But yeah, the capital side is where you're going to make the majority of your money. Maybe in 5 years' time, depending on your inkling, you could refinance, take a little bit of cash out, contribute towards the next and keep growing the portfolio.
Yeah, people talk about property as a passive income. And I know from speaking to many investors, it's not quite right. Is that, and you kind of touched on this in terms of, you said buy-to-let is the most passive, I think was your words. And then you've got others that are less passive. In terms of, and I've wrote down, buy-to-let, HMO, commercial, and development. I mean, sort of grade them in terms of time commitment versus expertise versus expense. You know where I think I'm going with that.
I know where you're going, Richard. So first of all, I'd say I've done a fair few property strategies, so I'm quite experienced in a few. So if we start with the most obvious, which is buy-to-let, that's what most people get into. That's, I'd say, the most passive bar, a commercial lease where you can let and forget about it for 5 years or whatever. Buy-to-let is good because generally you'll make more on the capital side compared to a commercial lease. Commercial is more about the income. You're buying the income.
On commercial though, for a new investor, a lot of people don't think about commercial at all. Yeah. Why is that?
I think it's maybe less sexy. Maybe there's less education around that space. However, we both know there are many benefits of purchasing commercial, especially if you're doing it within a pension scheme. Lots of tax breaks if you do that. But yeah, I think if we're to rank them, so buy-to-let is relatively passive. The income is relatively good. HMO is kind of like the polar opposite. So it's very, very passive. In fact, let's put it down here. It's very, very passive, but the income is good. So you've got to be willing to forego your time to make that money. And then, as we've just touched upon, commercial. I mean, commercial is a very general term. Let's use, we're letting it on a long lease, and the tenant is responsible for everything.
Yeah, a fully repairing lease.
FRI, yeah. So, in that sense, yes, it's pretty much hands off. You don't have to think about it. It's completely passive. It's great from your time point of view, but I think capital-wise, I think you're losing out. Your capital, the value of that property will only increase in line with the rents. So we're relying on rental increases to make this property worth more, which for me is a risk I'm not happy with. I like other factors to help push the price up of my properties aside from rent.
Is it fair to say, and I'm talking about a more general economic question, I suppose. We've got a situation where housing demand is high. We keep hearing talk about we need more housing. And conversely, on a commercial side, there's talk about AI and talk about jobs and all the rest of it. Is there the possibility of a reduction in commercial? So for a new investor, risk, I suppose, but does it present an opportunity for an experienced developer, I suppose? I'm thinking, conversions and things like that.
Yeah, of course. Commercial to resi has been a thing for the past couple of years now, especially with the more relaxed planning permissions around those types of conversions. And as we've seen in the past few years, the demand for large office space has just fallen off a cliff. good luck trying to rent out a whole building or a whole floor in a big block. It's just going to take you months and it's just not going to work out. So the smaller offices are working really well. Small serviced offices are working really well at the moment, but the large stuff, it's very, very difficult, it's very tricky, and that's why a lot of the commercial premises are being converted to residential. However, I'll be honest, that's a strategy that I'm not that experienced in, and I don't really like, because for me there are so many unknowns with that. To come up with the cost to renovate an existing commercial building and convert that to residential, there's so many unknowns because each commercial property is different. Whereas if you're building from the ground up or you're converting an existing residential property, it's so much easier to factor in how much the build cost is going to be.
In my experience, a lot of property investors tend to go on a bit of a journey. This is very much a generalisation, but they tend to go, I'll get a buy-to-let or a couple of buy-to-lets. They then might go, well, I might get a HMO now. Or then I might get a commercial. Or then I might do development. Is that fairly typical? Because there's different skills involved in each. Is that fair to say? And time commitments you mentioned as well.
Yeah, I guess I can't really speak for others, but for me, I'm just curious. So I like to do different things. So as you've mentioned, I've done I've done buy-to-lets, I've done HMOs, I've done land. I've got involved in some commercial projects. I've done quite a few different property strategies. A little bit of serviced accommodation. For me, I'm just kind of testing the water. If something works, great, let's double down on it. But actually, if something doesn't work, maybe we just want to stick to our core and what we know. So I think a bit about business, I'm hesitant to call it entrepreneurship, but a bit about business is you've just got to dip your toes in some different streams, and if they work, great. If not, don't worry, just focus on the core, because you could uncover some gold mines, some amazing idea or some amazing strategy that you're not currently pursuing at the moment.
So let's use law as an analogy. Lawyers tend to specialise.
Mm-hmm.
We've got a grounding in most things, but I'm not a wills and probate lawyer. I've got a general understanding, but it's not my core expertise.
Mm-hmm.
I suppose it's probably similar to an extent with property investors, in that you get some investors who are very experienced in a particular area and probably quite an advocate for a certain area. In your experience, to what extent do property investors collaborate? And a follow-up would be, should property investors collaborate?
Okay, so to answer the first question, first of all, I think most people will be surprised at how often investors do collaborate. I think there is a lot of collaboration going on, or at least the communities that I'm part of, we encourage collaboration, right? So that's a great and a good thing. However, there are some investors that see collaboration as a negative thing and see it as competition. So, for example, if I'm looking to buy in a particular area and someone else who I know is also looking to buy in a particular area, they could see that as competition. But actually, if you look at the probability of that being competition, it's fairly slim, because although, yes, we're shopping in the same area, A, it's highly unlikely we'll be doing the same strategies. B, it's also highly unlikely our numbers or our buy criteria is the same. And when you times those probabilities together, the odds are we're not going after the same types of properties, even though we're in the same area. And take Leeds, for example. Roughly speaking, 1 million people in Leeds. I don't know how many homes there are, but hundreds of thousands. So it's highly unlikely that we're going to cross over or cause competition for ourselves. So therefore, why not collaborate? And there's so many ways we can collaborate. And part of my network is actually about helping people collaborate better. Introducing A to B and thinking, well, how can these guys work better together? They've got complementary skill sets, and I think they can work well together. So there we have it. That is the first half of the interview between myself and Richard. I really hope you enjoyed it. If you do have any questions, please do comment below and I will reply personally. And I very much look forward to seeing you on the very next episode. All the very best with your property investing week. Goodbye.